All right, we're live. How's everybody doing out there? This is Jeremiah Condra from Annuity Association, and I'm bringing back another unbiased annuity review. It's been a couple weeks since we last conducted a review. I've been very fortunate to have been very busy the last couple weeks working with clients all over the U.S. And I'd like to start this review just by kind of sharing a sense of gratitude and that I'm thankful that I'm given this opportunity to help people all across the U.S. and point them in the right direction regarding their interest in annuities for retirement. And I've been very blessed to have had the opportunity and privileged, even more so, to work with so many amazing people the last few weeks from Texas, North Carolina, Illinois, California, Wisconsin, Michigan, Massachusetts. That was one of my favorites. The guy in Massachusetts, him and his lovely wife. And the one thing that I can say is that I'm super thankful that I have these platforms to be able to bestow some knowledge and education on these different various annuity products to help you identify with whether or not they're right for you in retirement. And even more so, that I'm a bit able to utilize the technology and tools that we have to help people all across the country compare the hundreds of different indexed and fixed annuities out there on the marketplace today. So the premise of each and every one of these reviews is to help you make an educated decision. And we do that through education. So just want to say thank you for watching. If you like what you've heard and you've gotten some value out of this, if you'd like the video here on YouTube or Facebook, and then share it with your friends and family, that will help these videos get ranked to help even more people find the information that they're possibly looking for when it comes down to making an educated decision. So without further ado, today we're going to be discussing the the Income Shield 10 offered by American Equity. This is a top-selling income annuity. It is a fixed indexed annuity with a lifetime income rider, and it's according to some independent research, currently ranks as of Q4 of 2020 as a top 10 indexed annuity in overall sales, and coming in at number 9. So today we're going to be looking at the features, benefits, rates, and more of the Income Shield 10 offered by American Equity. In this review, we'll be taking a look at the product brochure, breaking down the different features and benefits, and then taking it a step further and going into our software that we use here at Annuity Association and taking a look at some hypothetical scenarios to see what the guaranteed income amounts would be for a case study, a particular case study that we'll show you. And then we'll also be dissecting the various index strategies to see how they've performed over the last 10, 15, and 20-year period. So without further ado, let me go ahead and get started in our product brochure, or our disclaimer, and then we'll dive into the product brochure. Okay, I'm going to go ahead and share my screen. If you haven't done so already, you can enlarge your viewing window by clicking in the bottom right-hand corner of your screen, and hopefully it'll help you see it a little bit better. Okay, so again, talking about the Income Shield 10 offered by American Equity Insurance Company. This is an independent review by AnnuityAssociation.com. This is a review, not a recommendation to buy or sell an annuity. American Equity has not endorsed this review in any way, nor do we receive any compensation for this review. This review is meant to be an independent review at the request of our website visitors so they can see our perspective when breaking down the positives and negatives of this particular annuity. Before purchasing any investment product, be sure to do your own due diligence and consult a properly licensed professional should you have any specific questions as they relate to your individual circumstances. All names, marks, and materials used for this review are property of their respective owners and not that of AnnuityAssociation.com. While care has been made to ensure this review is complete and accurate, no guarantees are made to the completeness or accuracy. Okay, so we got that out of the way. Let me go ahead and dive into the brochure, and we'll get that pulled up. So before we get started here, if you're looking at indexed annuities or any type of annuity for that matter, and you're looking for The differences between various products. Maybe you've been pitched one annuity and you're interested in finding out if it's the best one available for your unique circumstances. Or maybe you're just getting into your research and trying to identify whether or not an annuity is right for you in retirement. I work with clients in all 50 states. I'm licensed with every major insurance company and annuity company that offers these amazing products. And if you'd like to work with me, you can do so by visiting our website at annuityassociation.com. Right there on the main page, click the green button to request your free report, and you'll be taken into an opt-in form with a series of questions. One of those questions will ask if you'd like to be contacted. Simply answer yes, and I will reach out to you in a timely fashion to get together and figure out a convenient time that we can discuss your needs, goals, and see if I can help point you in the right direction. So I'd be thankful for that opportunity. Okay, so we're talking about Income Shield 10, American Equity's income product, and it does have an optional lifetime income benefit rider. Okay, so let's dive in. Retirement is more than life after work. It's about enjoying the lifestyle you worked for, knowing that the money you earned is safe and the income you plan to live on is guaranteed. For many Americans, fixed indexed annuities help provide that financial security. Through a combination of protection and stability, these products help fund millions of retirements. The Income Shield design offers the guaranteed benefits of principal protection, tax-deferred growth, diverse crediting options, and income that cannot be outlived. So first, let's understand what a fixed indexed annuity is. I understand everybody watching this video, some may be familiar with them, some may not, but let's break down the basics of what an indexed annuity is first so that you can get a good understanding of how this can potentially be the right tool to help you piece together your retirement income plan. So a fixed indexed annuity is a contract backed by the financial strength and claims paying ability of the issuing company. This guarantees contract owners a retirement vehicle designed to protect assets while allowing for growth opportunities. It does this through a combination of powerful benefits. Some of those benefits are principal protection. So every dollar that you put into an indexed annuity is covered and protected 100% from any market volatility risks. You cannot lose a dollar of your initial investment or any interest that's been gained and locked in due to market declines. You also get a benefit of guaranteed income if you elect to add that optional lifetime income rider. You also get tax-deferred growth, liquidity, and in the event of a death, an annuity, because it is an insurance contract, it also may avoid probate. So an indexed annuity works by the retirement product being purchased with an insurance provider that in turn guarantees principal protection, tax-deferred growth on assets, and a reliable income stream. Throughout the course of the contract, the fixed indexed annuity can earn additional interest credits based in part on index increases. As an insurance product, the fixed indexed annuity is not directly tied to any index. So there are none of the exposure risks associated with direct stock or share ownership. The annuity cannot lose money due to index volatility, and the interest credited will never be less than zero. So let's talk about who American Equity is. For those that aren't familiar with them, for over 20 years, American Equity has been committed to the quality annuity products backed by their superior service. Today, as the number 3 all-time fixed indexed annuity provider, American Equity remains focused on the business principles that have served their contract owners from the beginning. Through their financial strength and ongoing stability, they help fund more than 500,000 contract owners' retirements across the country. As of the time of this brochure, American Equity manages approximately $57.67 billion in assets. They have over 21,000 active agents, 500,000 active contract owners, and it's American-owned and operated. They hold an A- rating from 3 of the largest financial stability rating companies. They are A- through AM Best, A- from Standard & Poor's, and A- from Fitch. So here's some key terms that we'll be talking about and discussing and using in the review today. So the first one is annuitization, which means a conversion of the cash surrender value of the annuity into regular guaranteed income payments. Accumulation period, the period of time during which the income account value is credited the income account value rate. Bonus vesting starting in the second year, a percentage of the bonus becomes guaranteed annually and vest over time in accordance with the vesting schedule. So in this product, there is a premium bonus. We'll be covering that here momentarily, so stay tuned. Cash surrender value, the amount paid to the contract owner by American Equity when the contract is surrendered. Contract value, the total of the values in the annuity contract. Death benefit, the greater of the contract value or the minimum guaranteed surrender value. Available death benefit payment options are listed in the annuity contract. And then free withdrawal. Opportunity each year after the first contract year to take withdrawals up to 10% of the contract value without expense. Sorry, guys, I'm trying to multitask here. I had a client reach out to me via text, so I just had to respond to them real quick. So bear with me. Okay, sorry about that. That just proves that we're live and that I'm not a professional spokesperson. This is all real time. Anyways, thank you. I appreciate the understanding. Income account value. This value is used solely to determine the amount of income to be received under the lifetime income benefit rider. It is not a traditionally accessible value. This serves as a measuring tool for the purposes of the rider only. So we'll be really breaking that down and what an income account value, or what's also referred in the industry as a income benefit value or income value. Income benefit base is another terminology. It's one thing that I wish all of the insurance companies and annuity companies would come together and just use the same language for everything, because it would make everything so much simpler. Hopefully, fingers crossed, that mandate will happen one day. But we'll be breaking that down and exactly taking a look at how that income account value grows according to the parameters of the lifetime income rider. The income account value rate is an interest rate used to calculate the interest credited to the account value, income account value. Interest crediting strategies. Contract owners choose from several index or fixed value crediting strategies, each offering different opportunities for growth. That's another thing we'll be doing today in the review, is taking a look at the index strategies themselves and taking a look at how they compare with the various ones that are offered. And we'll be taking a look at a hypothetical back testing that will show us how they would have performed if we owned this contract over the last 10, 15, and 20-year periods. There is a joint lifetime payout option available for those looking to purchase an annuity and cover you and your spouse's lifetime. And that is basically a joint life payout, which is available only to legal spouses as defined under federal law. Both spouses must be at least 50 years of age, and payment is based on the age of the younger joint payee. Payments are made through the life of the last surviving spouse, so long as spousal continuation is elected. And at no time will the cash surrender value be less than 87.5% of premium received, less any withdrawals accumulated at the minimum guaranteed interest rate. Okay, continuing on, there are partial withdrawals available in the annuity, which are available at any time. For partial distribution over the free withdrawal amount, surrender charges and minimum values will apply. The premium bonus at the time of this review is guaranteed 7% premium bonus on all premiums received in the first contract year. And there is a rider fee associated with that optional lifetime income benefit rider. The fee charge for the lifetime income benefit rider is based on the income account value and deducted from the contract value each year as long as the rider is attached to the contract. Single life payout for the owner and sole annuitant payouts are based on sex and age at election. Surrender is the termination of the contract in exchange for the cash surrender value. The surrender charge is a fee charge when applicable for full or partial distribution over the free withdrawal amount. And well-being benefit enhanced income payout is which is a payout that increases the amount of income payments by an enhanced income factor for up to 5 years. And that's only applicable with lifetime income benefit rider option 4 and 5. So in this product specifically, there are several different options when you elect to have the lifetime income rider added. we're going to be really diving into all of those options and even taking it a step further to see, which option is going to give us the highest amount of guaranteed income moving forward. So, ultimately, that's why we're looking at this product. If you're looking for guaranteed lifetime income to supplement Social Security and or pensions that you may have in retirement, this is a really great product to consider. And there are many different ways to customize the lifetime income rider component with the various options that they offer. But it really comes down to understanding each one individually and then taking a look even further to see, well, which option is going to be right for you? Which one's going to give you the highest amount of income, et cetera. So we'll be taking a look at that. So stay tuned. And here's a great chart on the power of a fixed indexed annuity. So that a fixed indexed annuity offers a powerful combination of benefits that help protect against many of today's common retirement concerns. So here's a great chart here. On the left-hand side, you'll see the fixed indexed annuity benefits that we've already discussed: principal protection, guaranteed income, tax-deferred growth, liquidity, and avoiding probate. And then you'll see the common retirement concerns of outliving income, index volatility, tax exposure, access to funds, and taking care of loved ones. And you'll see that in this particular product, there's a significant amount of boxes that are checked, which is a great thing. People want to get the best bang for their buck and really try to mitigate these top concerns of retirement and these risks that we all face. And an indexed annuity structured for lifetime income, really can help you accomplish these things when put together in combination with the rest of your plan. So if you're looking to, see how this product fits, we can definitely dive in and take a look and see what this product can do for you. Okay, so we've talked about all those, so I'm going to keep on rolling down. So the premium bonus, let's talk about that a little bit further. Before we do that, let's just cover this top column here. It says the Income Shield 10 is a fixed indexed annuity designed to help protect hard-earned dollars from index fluctuations while offering interest growth opportunities based on increases in an index. The premium bonus offered on the Income Shield 10 includes a 7% premium bonus on all premium received in the first contract year. The bonus is applied to the contract value on the date received, allocated into the same values as the premium, invest over time. This provides a jump start for the contract value because the premiums paid during the first year receive a bonus and can help increase interest growth from the start. So every $100,000 you put in, you're going to get $7,000 credited to the contract value of this annuity. And it's just a jump start. It's a way for these insurance companies that offer annuities to just add another competitive edge to, attract new clients and new market share. So the 7% bonus, very competitive. It's, one of the better offerings out there today. And it's just icing on the cake when you can get a strong product that also offers a bonus. Premium allocations are the initial premium payments that are allocated in any combination to either the fixed interest or any of the index strategies. Payments received after the initial premium automatically go into the fixed interest strategy. The contract values may be reallocated on the contract anniversary between strategies subject to these minimums. The premium bonus vesting is a schedule over a 10-year period. Each year after the first contract year, a percentage is vested until 100% invested at the end of the 10th contract year. The vested amount of the premium bonus is guaranteed and cannot be forfeited as a result of a free withdrawal. In the event of a partial withdrawal or surrender, premium bonus payments will be based on the vesting schedule. So we keep seeing the free withdrawal. We'll be talking about that momentarily, but most indexed annuities offer a free withdrawal provision that states usually after the first year in most products, you can withdraw up to 10% per year with no penalty. And, that's a nice piece of mind feature that you receive in that benefit because, retirement's dynamic and our needs change. And, God forbid, if you have an emergency that you need additional liquidity outside of your, investments that are not in the annuity and you need additional monies to supplement that need, well, this annuity can help you with that. So definitely a great perk to have and not something that we want to overlook. So allocation options, contract owners can allocate money using multiple interest crediting strategies. There's fixed interest strategies. There is an initial interest rate that's set at issue and guaranteed for the initial interest rate guarantee period, which will never be less than 1 year. The fixed interest strategy will never earn less than the minimum guaranteed interest rate of 50 basis points. And there are index strategies that are offered as well. This annuity contract also offers index strategy options to which premiums may be directed. The index strategies utilize a formula linked to one or more published indices. The index strategies currently offered are as follows. So we have the monthly point-to-point options, an annual point-to-point, and a 2-year point-to-point. So let's go ahead and break these down. So if you're new to indexed annuities and you're trying to learn how these index crediting options work and how your account value or contract value can grow, it really comes down to understanding these. So monthly point-to-point, first let's talk about what point-to-point means. When you buy this annuity and your annuity gets issued and placed in force, that will be your starting point, or the date that your annuity has been issued is your starting point, and you will receive communication that will show what the index that you're assigned to, or allocated to rather. It'll show what the starting value is of that index on that particular date. So that's your starting point. The second point, or the ending point of your crediting period, is the anniversary. So it can be either a 1-year or a 2-year strategy, depending on which one we pick. But at the end of that crediting period, you will also receive communication on what the ending value of that index was. And these indexes are publicly broadcast. So you can go to every single index that's out there offered in these annuities. You can look at the public domain or website to see what the values are and track them real time if you so choose. But you'll receive communication on what that ending point or ending value of the index was on your ending point. And if your ending point is higher than your starting point, well, then you had positive growth. And then that's what will be credited to your contract value in an indexed annuity. Now, when it comes down to the monthly, annual, or 2-year point-to-point, it's really a difference of the time and how the interest credits are calculated. So on the monthly point-to-point, on each contract anniversary, the interest credits are calculated based on monthly changes in the index over a 1-year period. So every month, the insurance company is going to look at that index and see what those changes were from a month-to-month basis. And then they're going to get an average for that year, and that's how they're going to credit your contract value. On the annual point-to-point, on each contract anniversary, the index price is compared to the previous year's index price. Now, on an annual point-to-point or a 2-year point-to-point, the only thing that differs between them is that length of time, but the concept and the crediting is exactly the same. It's from starting point to ending point. Now, there may be other terms that are used to determine what, and other factors that are used to determine what the index credit will be. Those can be terms such as participation, which means of that index itself and of the index's performance, how much do you participate in? So the index participation rates may be anywhere from 20% to 200%, depending on the product. And whatever that percentage of participation is, you multiply that percentage by the positive growth of the index, and then that's what your net credit is to your account. So for example, if your participation rate was 50% and your index performed at 10%, then you would receive 50% of that 10%, or essentially half, which would be 5%, as a net credit to your contract value. Hope that makes sense. The other term that may be used in these strategies, and we'll be diving into them and breaking them down, is there could be a cap. A cap is how much of that index's performance for that year or 2-year or even the monthly, and how much of that performance you're capped at. If you have a cap of 2.5% and the index strategy did 4%, well, unfortunately, you're only going to get 2.5% versus the whole 4%. So those are a couple of the different terms that we'll be looking at momentarily in this particular product. Now, in the index options, there are several available in the Income Shield 10. There's the traditional S&P 500, which is the market value weighted index of 500 stocks and a common benchmark used for the U.S. stock market. The S&P 500 Dividend Aristocrats, which is a daily risk control index. And that's a volatility control index that consists of the S&P 500 Dividend Aristocrats index and a cash component. This index is made up of S&P 500 members that have consistently increased dividends every year for at least the last 25 consecutive years. And in regards to calculation, so I already talked about this. I didn't see it down below, but they talk about what the cap and participation rates mean. So I'm not going to go into that since we already covered it. And then here's a really good thing to note is in the event of a death, 100% of the premium bonus is vested immediately, and the beneficiary receives the entire contract value, including the premium bonus, with no surrender penalties or withdrawal charges incurred. So one of the biggest misconceptions of annuities is that if you pass away, the insurance company keeps your money. That's entirely false. There's only one type of annuity structured in one type of way that would ever occur. And that's called a single premium immediate annuity structured for single life only. There's no income or benefit that goes to the beneficiaries should the annuitant or owner of that policy die. But that's the only one that's structured that way. In an indexed annuity, they're structured with a death benefit. And you'll always notice, and we'll take a look at an example illustration at the end, but there's a death benefit column that will always match the contract value. So even if you die within the first 10 years of the contract and you're still within that surrender penalty or surrender period, there will be no penalties incurred to your beneficiaries or charged to your beneficiaries. They'll receive 100% of the contract value plus the premium bonus in this product with no penalties, and it will avoid probate most likely. So just want to point that out, that is one of the biggest misconceptions. And any financial professional that you're working with that's against annuities, and that's one of the things they're trying to tell you. You know, I'm not here to badmouth anybody, but my advice is that person either doesn't know annuities at all or they're lying to you. And either way, it's not somebody that I would probably recommend working with, since maybe an annuity is right for you and they're biased against them. So with that being said, let's continue on. So let's talk about the money access options and features. With the Income Shield 10, there's always access to money in the annuity. American Equity provides withdrawal flexibility and a variety of liquidity options. So you'll see the first thing here is the premium bonus vesting schedule. You'll have the contract years listed at the top, and then the percentage of vested bonus for each year that you exceed. So at the end of the 10th year, starting in day one of contract year 11, that bonus of 7% is 100% vested. So what that means basically is if you did decide to cancel or surrender your policy and withdraw all of the money, let's say you did that in year 5, well, you're going to have the surrender penalty, and only 40% of that bonus that you received would actually be paid to you. You would not receive all of it because you're not holding up to your end of the agreement, which is that 10-year period minimum of keeping your monies in the account. Surrender values and charges. The annuity surrender value will never be less than 87.5% of the premium received, less any withdrawals accumulated at the minimum guaranteed interest rate. If a partial withdrawal above the free withdrawal or a surrender is taken during the surrender charge period, a deduction will be taken out according to the surrender charge schedule. So here we have the surrender charge schedule. Now this only applies to any dollars or any monies that are taken out above and beyond that free withdrawal of 10% per year. So you can access the contract value plus any interest that's been achieved or accrued over the period of time you've held it. And you can take up to 10% free with no penalties incurred whatsoever. But if you did decide that you wanted to take a little bit above that 10%, or maybe you wanted to take it all, there is going to be a surrender charge that will be applied. So for example, if you did do it year 5, there would be a 6% surrender charge that is applied to that withdrawal. Market value adjustments. This product contains a market value adjustment rider. An MVA may increase or decrease the amount of a withdrawal in excess of the free withdrawal amount or the surrender value. The market value adjustment does not apply to free withdrawals, any death benefits, the minimum guaranteed surrender value, or any distributions occurring after the surrender charge period has ended. In general, as the market value adjustment index increases, cash surrender value decreases. As the market value adjustment index decreases, cash surrender values increase. So not to get too far in the weeds there, but the easiest way to understand what a market value adjustment is, and it can be a movement positive or negative at the time of your surrender, that's above, or the withdrawal above the free withdrawal amount. But long story short, these insurance companies are purchasing large blocks, usually of corporate bonds. And, along with a corporate bond, there's an interest rate environment that affects, what those bonds are worth and how much they pay from a yield perspective or a coupon perspective. And if you were to, these insurance companies, the way they're able to offer the great benefits that they do is they're taking a large chunk of their money and they match your investment dollar for dollar. And then they go and they buy a large portion of corporate bonds that they use as the foundation of these annuity guarantees. And if you were to purchase an annuity, and there's a 10-year surrender period within this particular product. So basically what the insurance company most likely is doing is they're buying bonds, a large portion of bonds with their own dollars. And they're usually going to buy a bond that's equal or slightly longer in terms of a tenure or a term. In this case, it'd be 10 years. So they might be buying 10-year bonds, right? Well, if you're buying this annuity in a low interest rate environment, and during that 10-year period, somewhere, let's say in the middle, 6 or 7 years down the road, interest rates increase. Well, essentially those bonds that the insurance company bought 6 or 7 years prior at a lower interest rate are worth less, but they're only worth less if they don't keep them to maturity. And so if you exit the contract early because you didn't hold up your end of the agreement and keeping their money in there for 10 years, the insurance company is going to be forced to sell those bond holdings. And at that time, if the interest rate environment's higher than when they had purchased those, they're going to incur some losses, significant losses on those bonds. And so that loss is passed on to you, potentially, not always, as a market value adjustment. Now, it also works in the opposite manner. If interest rates are higher at the time you bought this annuity and interest rates decreased at that year 6 or 7 when you decide to cancel the contract, well, they're also going to give you a credit because the bonds that they purchased are worth more. So it works in each direction. It's not just a negative thing. So it can help you out either way, or potentially cost you more. It all comes down to just knowing that environment. But there is an index that they use to determine what those index rates are at the time of purchase and at the time of surrender, so that they can accurately assess whether or not there will be a positive or negative credit in the form of a market value adjustment. Okay, waiver of surrender charge rider. So here's some peace of mind coming your way. Another misconception is that, if you have a need for long-term care or nursing care of any sort in retirement, and you have your money in an annuity, that you can't access your money, so you're stuck. Well, that's not true either. So in this particular product, there is a nursing care rider that is added to the contract free of charge, and that's included automatically. And owners under the age of 75 at the time of issue after the first contract year, a one-time withdrawal of up to 100% of the contract value is allowed if the owner is confined to a qualified nursing care facility for a minimum of 90 days. Confinement must begin after the contract issue date. Written proof is required from both the qualified nursing care facility and recommending physician. Any payment made under this rider will not be subject to withdrawal charges. surrender charges, or market value adjustments. So there it is in writing. If you have a need for long-term care or nursing care of any sort, and you can meet the requirements of that 90-day minimum of being in that type of facility, you can access 100% of the contract value anytime after the first contract year with no penalties incurred whatsoever. There's also a terminal illness rider that's automatically included as well for clients under the age of 75 at issue. And after the first contract year, a one-time withdrawal of up to 100% of the contract value is allowed if the owner is diagnosed with a terminal illness. Diagnosis must occur after the contract issue date, and written proof with supporting documentation is required from a qualified physician. Any payment made under this rider will not be subject to withdrawal charges, surrender charges, or market value adjustments. And here's the death benefit. The death benefit proceeds are paid to the surviving joint owner. If there is no surviving joint owner, the death benefit is paid to the named beneficiaries with no surrender charges, plus 100% bonus vesting, generally paid in the lump sum. Other payment options are also available. All right, so now we're getting into the nitty-gritty. The lifetime income benefit rider, which is an optional rider that you can add to the Income Shield 10. I don't see why anybody would purchase this particular annuity if they did not want lifetime income, since that's what it's designed for. If you're looking for just safe growth, I would not look at the Income Shield 10 if you're just looking for safe growth. If you're looking for safe growth, there's other products out there that could potentially be a better fit. But if you're looking for lifetime income, this is one of the products to consider in your research. So what is the lifetime income benefit rider? The lifetime income benefit rider helps secure a lifelong income source for contract owners 50 to 80 years of age at issue. The amount of income to be received is measured by the income account value. The income account value is credited over time and grows until the earlier of income payments beginning at the end of the accumulation period. Depending on the option chosen, a rider fee may be incurred and will be based on the account value, income account value, and be deducted from the contract value each year the rider is attached to the contract. For option 1, income payments may begin 30 days after contract issue. For options 2 through 5, income payments may begin at any time after the first contract anniversary. These payments are available without a surrender charge or having to annuitize the contract. So the easiest way to understand kind of what's going on here with these income account values and contract values is I always take my clients through what we call a T-chart exercise. So if you take a piece of paper and write a large capital T across that sheet of paper. On the right-hand side of that T, at the top, you're going to write income account value. And on the left-hand side of that T-chart at the top, you're going to write contract value. So in an indexed annuity, you have two moving parts, okay? Contract value on the left, income account value on the right. And each of those parts have different ways that they grow. When you have a lifetime income rider, that applies to the income account value, okay? So on the right-hand side of your T-chart, when you put in, let's say you put in $100,000, that $100,000 is going to go into the left-hand side of your T-chart under the contract value, and that $100,000 is also going to go over to the income account value side of the T-chart. The lifetime income rider and the components or parameters of how the lifetime income benefit or the income account value grows is all contractual. So in these income annuities, you might have a guaranteed interest rate only on the income benefit in the range of anywhere from 5 to 7% compounded per year. On the left-hand side of your T-chart, that contract value, the only way that can grow is based on the index credits and or a premium bonus that's applied to the contract value. So in this case, 7%, there's a 7% premium bonus that would be applied to that 100,000 going in. And so in that year one on your T-chart, under the contract value, you're going to see 107,000 to start because of that 7% bonus being applied to the $100,000. That contract value can only grow based on how the index strategies you're allocated to perform over the life of the contract. So in years where there's no performance, you're going to be given a 0. But in years of positive performance, you're going to be credited to that contract value side of the T-chart. All while, regardless of what that contract value is doing, whether it's growing or not, on the right-hand side of the T-chart, that income account value, that's growing guaranteed. That's why you buy a lifetime income rider. That part of the product, grows guaranteed based on what the contract of the income rider states. And so we'll be taking a look at that. But in this case, on right here are the 4 or 5 different, 5 different options for the lifetime income benefit rider on the Income Shield 10 from American Equity. So option 1 has a set income account value rate declared at issue and guaranteed for 15 years. The income account value is calculated on a compound interest basis, and there is no fee associated with this option. So there's no rider fee on option 1. And that income account value rate is guaranteed at the time of this review, 4% per year compounded for up to 15 years. So let's say you were 55 years old and you're planning on turning income on at age 70. You're guaranteed that you could grow this money that's in the annuity and grow that account value, income account value at 4% a year with no market volatility risk, none of that. It's 4% growth guaranteed, compounded for up to 15 years. That's contractual. That's in the rider contract. When you sign your application, you're going to sign that contract. And the one thing to note is that an income account value or income benefit, those values are not withdrawable as lump sums. So yes, you're getting a 4% interest rate applied to those dollars, but you can't withdraw it. You can't just say, hey, you know what? I'm happy with this 4% growth over the last 10 years. I'm just going to take it as a lump sum. You can't do that. When you're designing it for income, that income account value or income benefit base is solely used to factor the guaranteed lifetime income amount in the contract. So again, option 1, 4% guaranteed compounded interest rate for up to 15 years applied to the income account value. Option 2 has a set income account value rate as well, declared at issue and guaranteed for 7 years. The income account value is calculated on a simple interest basis. So this option is not compounded. It's simple interest, and the interest rate is 7.25% guaranteed for up to 7 years. Now, there is a rider fee associated with option 2 of 1.1%, and that is charged against the contract value. So your initial premium plus any index credits, that 1.1% rider fee is charged annually to the contract value of your T-chart. Okay, we'll look at the example illustration here at the end of this review to kind of give you an idea what it looks like. Option 3, this option has a set initial income account value rate declared at issue and guaranteed for the initial income account value rate guarantee period of 10 years. The income account value rate will never be lower than the minimum guaranteed income account value rate for the remainder of the accumulation period. The income account value is calculated on a compound interest basis. So option 3, compounded 6% income account value rate. Minimum guaranteed income account value rate is 3%, and the accumulation period can be up to 15 years. And there's a rider fee of 1.1%. There's also the living income benefit rider and well-being benefit options. These allow for increases in the income of the income. Let me read that again. I'm sorry about that. These allow for increases in the amount of income by an income payment factor for up to 5 years, should the contract owner or their spouse become unable to perform multiple activities of daily living outlined in the contract. This option is not confinement driven, so it is available to those receiving home care as well. There is a 2-year waiting period before the benefit can be activated. So this is a huge additional perk. I'm sure while we were reviewing that nursing home care rider that's included at no charge, You were probably wondering, well, what if I don't want to go into a nursing home, but I still need specialized care at home? If that's the case, if that's the concern, they do have this well-being benefit option that can be elected. And these are found in options 4 and 5. And that well-being benefit option covers home care as well. So option 4, this option includes the lifetime income benefit rider guarantees with a set income account value rate declared at issue and guaranteed for 7 years, plus the well-being benefit. The income account value is calculated on a simple interest basis. So here to the right, option 4, we have the income account value rate of 7.25%, simple interest, accumulation period of 7 years guaranteed, and a rider fee of 1.20%. This particular option is not available in Delaware at this time. So if you're wondering why that is, every state governs their own body of insurance and annuities. So for whatever reason, Delaware has not approved these options. Not too sure why that is, but it is available in all remaining 49 states. Option 5, this option includes the lifetime income benefit rider guarantees with a set initial income account value rate declared at issue and guaranteed for the initial income account value rate guarantee period of 10 years. The income account value rate will never be lower than the minimum guaranteed income account value rate for the remainder of the accumulation period. This option also includes the well-being benefit. The income account value is calculated on a compounded interest basis. So option 5, we have to the right here the income account value of 6% and the minimum guaranteed income account value rate of 3%, accumulation period for 15 years, and the rider fee of 1.20%. And again, this option is not available in Delaware. Sorry, Delawareans, if I think that's what you guys call yourself. If you live in Delaware and you're looking for the well-being benefit rider, unfortunately, it's not available. But maybe there's another product out there that is. And if you'd like to find out if there is one, or you'd like to work with me directly, either way, you can visit our website and go to annuityassociation.com. Right there on the main page, click the green button to request your free report, and I would be happy to assist. On that opt-in form that you're taken to, there'll be a question on whether or not you'd like to be contacted by an advisor. Simply answer yes, and I will reach out to you in a timely fashion. Okay, so not going to get into this too much because we're going to be able to dive into the software that we use here at Annuity Association that's going to show us all of this information anyways. But this is the basically the income payout factors. Not necessary to go over that at this time. If you'd ever like to do so independently, please feel free to reach out to me. So we've talked about income payment elections. You can choose single life or joint life, and income can start beginning after the first 30 days or 1 year after the contract is issued, depending on the rider option that's chosen. Death of the owner. Again, American Equities annuities have a death benefit that allows the beneficiaries immediate access to contract value at the time of death. This can help avoid a costly, prolonged probate process. We've already talked about that, so I'm going to keep on moving on. Excess withdrawals. They're talking about anything above and beyond the free withdrawal provision can reduce future income payment options and your income account value on a prorata basis. For example, an additional withdrawal of 5% of your contract value reduces your future income payments by 5%. So it's dollar for dollar. If you happen to withdraw from your contract value while receiving lifetime income, or even if you're not receiving income yet, any withdrawal you take out of the contract value side of the account will impact dollar for dollar on your income benefit moving forward. If an excess withdrawal plus income payment exceeds the free withdrawal amount allowed in any contract year, surrender charges will still apply to any amount in excess of the free withdrawal amount. Should excess withdrawals reduce the contract value to zero, the income account value will also be reduced to zero, and the contract as well as the rider will be considered surrendered. Any remaining income payments would also terminate. So really, when you're looking at an income annuity, the best thing to do is to really make sure that you're doing the proper planning, and that the money that you're putting into the annuity is really money that you're pensionizing. You're not really looking at it for future withdrawals. I mean, it's there if you need it for an emergency, and that peace of mind knowing you do have additional liquidity should you need it. But the rule of thumb is that you should plan on never needing it. I mean, you should really plan on having liquidity outside of the annuity that could cover those rainy day events should they occur sometime in retirement, so that your annuity and the income that you've earned over the time of owning the product is intact and stays whole. You never really want to, withdraw from the annuity's contract value, because it is going to negatively impact your income benefit moving forward. Okay, tax treatment. All income payments are considered a withdrawal from the contract value, and any part of the withdrawal that is deferred interest is taxable as income. If the contract is in a qualified plan, the entire amount of the withdrawal may be taxable. The taxation of income payments is calculated as outlined in the Internal Revenue Code. In addition, the taxable portion of any withdrawal taken before age 59 and a half may be subject to an additional penalty of 10% by the IRS. Please contact a qualified tax professional for more information. So American Equity, again, just ending on who they are and what they're about, is they do stay and remain committed to their values. Their values are service. They understand their contract owners or why they're here, and they do their best to provide service second to none every day. For those not aware with American Equity and the customer satisfaction and the level of satisfaction that's consistently put in day in and day out, year in and year out, they're consistently and regularly recognized by companies like J.D. Power and Associates for overall customer satisfaction. I believe last year, 2020, they received the third highest ranking in overall customer satisfaction across insurance companies from J.D. Power and Associates. So really big accomplishment there. When it comes, I get asked often, by my clients or prospective clients, who's the best company? Or if they say, I'm looking for a company that is all about their customers. They don't treat you just like a number. And when you call, you're going to get a live person in a acceptable amount of hold time. American Equity, I can say with confidence that that's one of them that I feel confident in terms of recommending to clients if those are the things that are most important to them. They operate with integrity. Their values of honesty, fairness, and truthfulness have been central to our past success and will continue to be for generations to come. American Equity is one of the few insurance companies out there that is very transparent in how they operate. They're also transparent with their products and what their renewal rates are and things of that nature. They're one of the first insurance companies to actually publish their renewal rates on their interest and things that they offer inside of their annuity products. So, that's really says a lot. If they're willing to really publicize, the kind of service and values that they're offering their clients, and they do so consistently, I mean, what better thing to ask than for a company to be willing to do that? Excellence, their dedication to going above and beyond in every facet of their business has established them as a top-tier fixed indexed annuity provider. And safety, their products provide sleep insurance, which is a coined phrase by American Equity, for contract owners that can trust their principal is protected and their income is guaranteed for life. So if you're looking for sleep insurance, American Equity may be the company for you. Okay, let's go ahead and dive into our exercise and our software. So I already have the Income Shield separated or filtered here for this exercise. So what we're doing is looking at a case study of a person located in Florida. It's a male, age 60, and they're looking to put $100,000 into the Income Shield 10 with American Equity. Now, this is just a practice example to show you how this income annuity would work, and more importantly, to show you how we can really assist you in finding the right annuity for income or right annuity for growth, for that matter. Using our software and our tools to show you how we're able to do that. So For those not familiar with our company, Annuity Association, we're an independent firm. We offer annuities. We're independent, so we work with every major insurance company in the United States. And one of the most important things is that we operate with the best interest standards and suitability for people looking to buy annuities. So what that means for you is that being an independent advisor, we're able to understand your needs and your goals and objectives for this money and for this plan. And we can go and utilize our tools to compare annuity to annuity, apples to apples, apples to oranges, whatever the case may be, to help identify which product is going to be the best for your unique situation. Not all annuities are created equal. Not every, especially people's circumstances, there's never one that's the same. So every product is designed a little differently to cater to a different need or different purpose. So with that being said, we utilize our tools here to help us identify which product is going to give us the highest opportunity to meet our objectives. So again, if you're interested in working with me directly, I work with clients in all 50 states. I utilize Zoom as a secure portal to conduct our meetings, to understand what's important to you. If you'd like to work with me directly, I'd be honored and privileged to do so. You can visit our website at annuityassociation.com. Right there on the main page, click the green button to request your free report. Answer the question of whether or not you'd like to be contacted by an advisor. Simply put yes, and I'll reach out to you in a timely fashion. Okay, so what we're looking at here is we have the $100,000, male, Florida, age 60. And then you'll see that we have a deferral bar here, which is dynamic, and we can slide this up and down depending on how long we plan on deferring the income stream. So for example, if this person's 60 years old and maybe they're looking to defer income to age 67, if they're planning on turning Social Security on at 67 and they want this income stream to turn on as well to supplement that retirement income stream from Social Security, then what we can do is go and choose 7 years for deferral, and you'll see that income's going to start contract year 8 at age 67. And then what's neat about the software is it's going to automatically show us in chronological order from highest to lowest in terms of which lifetime income benefit rider option is going to give us the highest economic benefit. And so in this case, option 2, which includes that 7.25% guaranteed roll-up with the 1.1 fee. So you'll see we operate very transparent. We have all of the rates of the income rider to the right, the fee, and the roll-up period, and then how long you'd have to wait before you can turn on income with that particular product. In addition, we take it even a step further, and we also figure out using our hypothetical backtesting exercise to determine which of the 2 or 3 index strategies that are offered in this product are going to offer us the highest economic benefit for growth on the contract value. And so what we do is we backtest them over the last 10, 15, and 20 years. And in this particular exercise, we're looking over the last 10 years. If we owned this product during that time, how would that index strategy have performed? Well, the 1 year S&P 500 point to point with the monthly sum cap strategy would have performed on average 3.01% average annualized rate of return over that 10-year period. And then you'll see that we also have the 7% premium bonus listed here as well. So we're on this page, you see 8,275 in the bold green numbers. And if we go down below that, you'll see there's also another 8,275 option, and that one is option 4, which includes the 7.25% roll-up and the well-being benefit rider. Now, the only difference between the two, and it's exactly why the guaranteed income amounts are the same, is that with that well-being rider option found on option 4, the rider is 1.2% fee versus 1.1% on option 2. So 10 basis points more, and you're getting the well-being benefit rider. And then the other difference would be that on option 4, you're going to get that well benefit income option, that income benefit. So that actually doubles the income payout. So you'll see from $8,275, if you qualify for the well-being benefit rider, the income will double to $16,550 a year for up to 5 years to cover the cost of care. And keep in mind that well-being benefit rider includes care at home, not nursing home. You don't have to be in a nursing home for that rider. So you get a lot of peace of mind there. Now, this is all based on $100,000. And if you notice to the right of the bold green guaranteed annual income amount, you'll see a large 6-figure there. This is $161,303. Now, what that number is that's your income account value. That's the income account value that's been growing. Remember your T-chart. On the right-hand side of your T-chart, that number has been growing. The initial 100,000 has been growing in this example by 7.25% guaranteed simple interest rate. So it grows after 7 years of deferral to $161,303. In addition, you'll see that then there's a formula multiplied. That 161,303 is multiplied by 5.13%. So the 5.13% is essentially the what we call payout rate or distribution rate or withdrawal rate. Again, every company calls it something different. I call it the payout rate. It's just an easy way to remember. It's the payout rate of the income account value. What percentage are you being paid out? And in this formula, this number here is based on the age at the time you elect to turn on the income. So if I went down to 5 years of deferral, we're going to see that these numbers change. We'll see that payout rate went down, and we'll see that the income account value went down. And that's because we had less time that it was deferred and we were younger. Those are the two reasons. But again, going back to 7 years, we'll see that income account value grow to 161,303, and then the payout rate of 5.13% is what equals 8,275. Simple math. Now, let's say you actually wanted to go to age 70. Maybe you defer it for 10 years and you turn it on at age 70, which would be contract year 11. Well, take a look at this. Now we have a new income account or income value or income payout rather of $10,386. That's guaranteed. But look what changed. Option 2 is no longer number 1. It's option 5. And it's because of option 5 having a 6% compounded rate in the first 10 years, and then a continuation of 3% guaranteed compounded rate in years 11 through 15. And it has a max roll-up period of 15 years. So because we've deferred it for 10 years, this particular rider option would be more beneficial for this person. And you'll see the income account value grows to $191,621. And then because the person is older, the payout rate is also increased to 5.42%. And then you'll notice option 5 is also that well-being benefit rider option, which would double the guaranteed annual income for up to 5 years. And it increases it to up to $20,772. That rider fee is 1.2%. All right. So I think you guys see the power of really understanding the different products that are available, the different options, and how they, this decision making needs to be done from an educated perspective. And you need to work with a professional that understands these products to help you, and has the right tools to help you decipher them. And I'd be honored to do that with you. If you're interested in working with me, again, go to annuityassociation.com. Right there on the main page, click the green button to request your report. Answer yes if you'd like to be contacted, and I will reach out to you in a timely fashion. All right, so we're wrapping up here. I got one more area to take a look at, and that is the indexes themselves and the index crediting options that are available in the Income Shield. Let's take them through a quick back testing exercise to see how they would have performed. We're going to help you understand which index using this exercise would be most beneficial potentially beneficial moving forward to give you the highest economic benefit for growth or highest opportunity for growth. So if we look here, we've got the Income Shield index crediting strategies here listed. We have, and they're listed in chronological order according to the highest hypothetical performance over the last 10 years from December 31st of 2010 to December 31st of 2020. And we'll see that the 1-year S&P 500 monthly point-to-point with the sum cap comes in number 1. And we'll see that the average rate of return, average annualized rate of return over the last 10 years in this exercise is 3.38%. We'll also see that that's also the best 10-year period over the last 20 years. So if you look below those numbers here on the right, you'll see a green and red number. What our software also does is takes a look back over the last 20 years and identifies the best 10-year period. And in this case, it happens to be the last 10 years, which was December 30th of 2010 to December 30th of 2020. And then the red number, still a positive number, but it's just red to indicate the lower of the two, is indicating the worst 10-year period over the last 20 years. And in this case, it was from December 30th of 2006 to December 30th of 2016. Now that's an important data set there because it's taking us through that 2007, 2008 global financial crisis where the markets crashed and took several years for them to break even. Even with that being said, still experienced 1.53% in positive growth. So not a lot there on the indexing side, but still something. On average, over the last 15 years, we're at 2.8% average annualized rate of return on this S&P 500 point-to-point monthly sum cap strategy. And then over the last 20 years, we're at 2.61%. Now, keep in mind, this annuity is designed for income as the intended purpose, lifetime income as the intended purpose. If you're looking at these numbers for the index strategies, which account that credit the contract value, if you're looking at these numbers and you're saying, they're not really all that high, first off, I agree with you, but you have to understand the intended purpose. If the intended purpose is lifetime income, most lifetime income annuities are not going to give you a strong accumulation opportunity on the contract value because they're giving you a much higher benefit on the income side. So it really comes down to weighing out the pros and cons and what's going to be the most beneficial for you. There are products out there, and it just comes down to finding them that can give you a blend of both and do so very competitively. And, something I would recommend if that's what you're looking for. But if you're looking for strong lifetime income, this is going to be one that may be suitable for you. Okay, so we have the S&P 500 monthly sum cap coming in, number 1, but then we have the S&P 500 Dividend Aristocrats, daily risk control 5% coming in here at the bottom. I guess it's ranked number 5 on the list, and you'll see average 10-year performance at 2.69%. So if you were looking to get the best index strategy based on this hypothetical backtesting exercise, the S&P 500 point-to-point monthly sum cap would be most likely the better of the two. But again, none of us have a crystal ball. Prior performance is not an indicator of future performance. So just take that with a grain of salt. Okay, so last but not least, let's go ahead and dive in to an example illustration. All right, so we're going to go ahead and pick the Income Shield. We're going to put the monies into the S&P 500 point-to-point monthly sum cap. Oh, let me change it to Florida just to make sure we're comparing apples to apples with all the examples we've done. Okay, there we go. Now, you are able to diversify in indexed annuities where instead of putting all of your money allocated to one index strategy, you can break it up across several. It's not uncommon to do so. I do usually highly recommend it depending on the product and the purpose. But in this case, for this example, we're just going to put it into that top index strategy in this particular product. Now, there are, again, 5 different lifetime income benefit rider options. I'm just going to choose option 2 for now. We'll use the initial example on that guaranteed income calculator exercise where the gentleman's deferring it for 7 years, turning income on at age 67. Okay, here we go. So again, male 60 in the state of Florida, $100,000 going in. And we're going to come on down to the current rates and the hypothetical back test to 10 years. So we have $100,000 going in, and you'll see right away that account value jumps up to $105,738. Now, these are the ending values. Okay, so if you notice at the top of our illustration, we have end of year. So you were probably wondering, well, I thought it had a 7% bonus. It does. The 7% bonus would have made it $107,000, but after factoring in the rider fee of 1.1%, which you'll see in this purple column, the rider fee is charged against the account value. So that's why the account value is $105,738 at the end of contract year 1. Now, you'll notice there was no interest credit earned for that particular year based on the way the last 10 years performed with that strategy. And you'll notice that the income base is at $114,000. So this is that income account value on your T chart. That's the right-hand side. $114,758. Now, that number, again, remember, is growing based on that 7.25% guaranteed roll-up rate. So that's why this number has grown to where it is. You'll notice the income account value, which is the income base column here, and the account value will always differ. And usually, most times anyways, the income value will always be higher than the account value. Okay, so we'll keep on rolling down. So we'll start to see some interest credits apply, and you'll see the account value increase. And then you'll see any years where there was a 0, maybe there was negative performance on that index strategy, the account value goes down because of the rider fee that's being charged over here. Okay, so as the account value increases, the 1.1% rider fee applies and to that account value, and you'll see the rider fee does fluctuate with how high the account value is. You'll notice the interest credits at the end of year 7 grow in this particular exercise, grow the account value to $124,270. And the income base during that 7 years of deferral has grown to $161,303. We'll see the income amount that's guaranteed for life starting in contract year 8 at age 67 is $8,275. And then once income turns on, you'll start to see that it comes out of your account value. That's the way an annuity logistically works. When your income comes out, it reduces your account value. Now, you do still receive interest credits, okay, as they unfold. So it's still going to go down, though, because essentially you're taking off in this particular annuity, you're taking, at least 5.13% in an income stream off of the account value. So you would, to maintain principal, you would need your income index credits rather to at least equal the amount you're taking out. So that's why you start to see the income value or the contract value rather go down. Now, even if the account goes to 0 in this exercise, the account value does decrease, or the contract value does decrease to 0 at the end of year 22. The income is for life. It goes forever and ever. You live to 110, it's going to keep on going. Okay. So that's really going to wrap up. The last thing I want to point out is the death benefit. You'll notice the death benefit column all the way to the far right will always match the account value. So in this example, let's say the person passed away contract year 7. We have $124,270 in the account, $124,270 in death benefit. Let's say they pass away year 15. There's $63,046 and $63,046 in death benefit, so on and so forth. So hope that explains how this works. This is just an example illustration. If you'd like to get one that's more tailored to your personal situation, or you'd like to work with me directly, I'd be honored to do so. You can visit our website at annuityassociation.com. Right there on the main page, click the green button to request your free report, and answer yes if you'd like to be contacted by an advisor, and I will reach out to you in a timely fashion. If you've gotten some value out of this video, or it's helped, raise your annuity education quotient up to a higher level, first off, I'd like to thank you for watching. That was the intent, is to help you make an educated decision. But if you like this video, give us a thumbs up here on YouTube or Facebook, and share it with some friends and family. It helps the video get ranked for other people across the country looking for information the same as you. So would be grateful for that as well. Anyways, if you'd like to, again, have any questions, reach out to me or comment on this video here below. Otherwise, this is Jeremiah Condra from Annuity Association signing off. Hope everybody has a great day out there, and take care of one another. Thanks so much.